up front here on ENCA. Thank you for joining us. That briefing coming to you from the South African Reserve Bank, the governor, the Elize Kruger, delivering the decision of the Monetary Policy Committee. And it's a hold, folks. Inflation trajectory pleasantly surprising the governor on the downside, on the decline, but not enough to convince them to give you, if you hold loans, for example, an early Christmas present by perhaps dropping the interest rates. It's a hold at 6.5%. The governor there mentioning concerns about economic growth and expecting the third quarter GDP to be weaker, and also talking about the overall GDP for this year revised downwards to 0.5%. Bad news. Devan Murugan from ENCA Money Desk standing by to unpack it all and tell you what it all means. Devan?
Well, thanks very much indeed. Tulis, so there you have it. I mean, in a nutshell, the repo rate stays at 6.5%. Your prime lending rate at banks, I'm afraid, no early Christmas present. It stands at 10%. That's the prime lending rate. And as Tulis said over there, I mean, yes, inflation does seem to be going on the downside. Good news there, but not enough to convince the Reserve Bank Governor and the MPC that there is no dangers to the risks. So for more analysis now on the MPC rate decision, I'm joined by Annabel Bishop, Chief Economist at Investec, and Elize Kruger, Senior Economist at NKC African Economics. Thanks very much indeed, ladies, for coming through. Elize, I want to start with you. So here you have these inflation projections, 4.2% for this year, and when you consider the next 2 years, all still below the target band. Why is it that we didn't take that as saying, well, inflation is good enough to give us that rate cut?
Well, Devan, yes. I think at the current level of inflation as they predicted it, I didn't expect them to cut today. But if you incorporated, the last two CPI releases that were both notably better than expected, especially yesterday's number as well, the starting point of the CPI forecast curve has lowered considerably. And with not changing the forecast for next year, it indicates to me that the Reserve Bank have not incorporated the better than expected numbers over the past month or two that would have resulted in that notable downward movement in the CPI curve. Now, to the extent that I forecast next year's CPI now at 4.5% compared to the bank's 5.1%. And actually, Lesotho could have used the opportunity to celebrate the 4.5% is exactly in line with what they would like to see, but they chose not to revise their CPI down. And I think that's been an error in my view. Looking at inflation now, I think it's definitely more muted than what is projected by the SARB. So I think if they did revise downwards, there would have been an opportunity for them to perhaps, look at an interest rate cut. But with 5.1 next year, I agree that that's not as narrow to cut on. Given the risks, obviously, as you pointed out, on the country risk side, potential downgrades, potential rand weakness. So there are many risks out there. But in terms of inflation, I think they have missed the opportunity to revise downwards.
Right, was that enough, Annabel, to actually have missed the opportunity? It could have been an early Christmas gift, just give consumers a little bit of relief. He didn't do it.
Yes, and I think it probably would have spurred a bit of confidence as well. But, the fact really is the Reserve Bank doesn't target, what inflation is now, or indeed even what inflation is in 6 months' time. Essentially the Reserve Bank has said its key target period is 12 to 18 months out. And that really escapes next year and takes you into your 2021 period. And, of course, if it is 6 to 24 months out, it really only gives you the last 6 months of next year. Or maybe a few more, but, we really are rolling through the year quite quickly. So I think, the point really is perhaps, the Reserve Bank could have given us a cut because our forecast ties in with Elize's. We also have around about 4.5% for next year, and indeed for the following year we do have about 5% for 2021. But of course that's quite far away, and if you continue to get these surprises on the downside, you're going to see even a lower outcome for next year as we roll into it. And of course then obviously factoring that into the following year, you've seen this structural rate of inflation actually moderating, and that's quite key. We've seen a structural downward trend in economic growth in South Africa since 2011, from 3.3% to likely 0.5% this year. Structurally, we're also starting to see the long-term inflation rate starting to subside as well. And when it does that, and when they believe it's become embedded, as he says, they're hoping that expectations become fixed around 4.5%, they probably will be more willing to cut. It doesn't really matter, I suppose, what we feel. It really matters, what the Reserve Bank is viewing it as. And of course, being very concerned about a credit rating downgrade, should it happen, because obviously that would push up both your long-term borrowing costs, but have a substantial impact on your money market rates in the short term, and of course thereby impact the repo rate. So, very uncertain times, I think, the Reserve Bank is conveying, and probably one of the key reasons why it sat on its hands and didn't change the rate.
I want to stay with you, just looking at the numbers here of those committee members that voted for and against. I mean, 3 voted to keep on hold, 2 said cut rates by 25 basis points. So you never really had a unanimous view here that we should keep this on rates. 2 people or 2 members actually saying, give it a go and cut. What do you make of it?
I think it may even be an early indicator that we could get a cut in the first quarter of next year. Not necessarily January, I don't think January, but possibly in March. January obviously is before the budget, and they're also concerned about the budget, the figures, the fiscal risks. After the budget, if it's a good budget, and indeed if we even see Moody's put us back on a stable outlook, I think it's probably a near certainty we'll get a 25 basis point cut in March. And I think, the fact that you're seeing this, not actually a split, but close to a split. 2 committee members really keen to cut rates, I think gives you an indication of the concern that potentially is growing at the Reserve Bank for this weakening growth trajectory that we're really experiencing. If we've had economic growth last year of closer to 1%, this year of 0.5%, if the trajectory continues, you're approaching 0%, and I think that worry is growing at the Reserve Bank. So we're starting to feel we may well get an interest rate cut next year.
So consumer spending, Elize, makes up, 60% of our GDP. Even if we've got 25 basis points, it would have went, even if it's a fraction, towards some sort of growth in the country. Just impact-wise, what would a 25 basis point cut do for the economy, you think?
Yes,
Very much or little?
Probably a marginal positive impact even, but I think also, as Annabel mentioned, confidence-wise, it could have been a bit of good news for a consumer that had to deal with high tax burden this year, elevated fuel prices, high administrative costs. There's just more and more negative news. It would have helped on the margin. So those with loans would have had a couple of extra bucks in the pocket for Christmas time. So yes, it wouldn't have changed the trajectory in terms of the levels of growth. I think we are still stuck below 1% this year and probably next as well. But it would have helped a bit on the margin. And I think, actually we need a bigger cut to make a more meaningful impact. But for that, risks in the economy are, at this point in time, way too high. But yes, a bit of good news could have, gone far to just lift confidence a bit.
0.5% for GDP growth, I mean, that's still so dismal, so weak. It doesn't speak a lot for employment, does it, Annabel?
No, it doesn't. And what's really worrying is when you have economic growth at such very low rates, it is insufficient to absorb your incoming job market entrants, to absorb those who want to work and haven't been able to find a job. And if you continue to see your growth rate of these incoming entrants, you're actually going to see unemployment rising at this low rate. So, we've seen it now reach 30%. That's our formal unemployment rate. The expanded unemployment rate closer, if not beyond, 40%. Quite interesting, at the end of the last decade, around about 2008, we saw the expanded unemployment rate at 30% and the formal sector unemployment rate at 21%. So, almost over a space of 10 years, we've gone from 21 to 30%, and we could now climb higher than 30% because our economic growth rate is just too weak to make any difference at all, and it's so weak that it can't absorb the incoming entrants as well. And the impact of those two could actually now see unemployment starting to rise above 30%.
Elize, I want to close up with you very quickly. So what did the models say? Third quarter next year we might see an interest rate cut. Do you think we could see something earlier?
I agree to see it earlier, especially if they adjust the CPI forecast, because the CPI gap, in the model, the variable, should have signalled, in my view, potentially an earlier cut. So I think by not changing the forecast for next year, they kept the potential for a cut out, into the future, not to feel pressurized to do it now. But I think if they did adjust, in line with private sector economists and, people number crunching just after the CPI release yesterday, it would have probably signalled a cut either now or very soon thereafter. But unfortunately, we're going to have to wait for the budget and then for Moody's, and, I doubt whether they're going to cut before that.
Right, and it basically means that if you're paying a home loan or a vehicle at the moment, stay with it through Christmas. It doesn't get easier with your loans. Well, thanks very much indeed, Elize Kruger from NKC African Economics and Chief Economist at Investec. Annabel Bishop, thanks indeed for talking to us there. So there you have